Tanya, you can hear me?
Yes, sir, I can hear you. I hope even I'm audible.
Yeah, loud and clear.
Sure.
So, how much time we have? About half an hour, right?
Yeah, sir, we are live in another 2 minutes.
Okay. ये बराबर है क्या? देख, थोड़ा आज का रिफ्लेक्शन आता है ना तुम्हें। बिल्कुल। थोड़ा ज्यादा नजदीक होगा ना। नहीं तो ये फिर ठीक।
Hello, everyone, and a very warm welcome to all of you. Good evening, everyone, and welcome to our session on rising yields, shifting strategy, fixed income outlook for the month of September 2025. So, it's an extraordinary time for debt markets. Globally, the conversation has shifted from how long rates will stay elevated to when central banks, especially the US Fed, will begin descending on the rates. With Jackson Hole Conference setting the stage for what could be a new easing cycle, meanwhile, bond investors are navigating the slowing US economy, fragile consumer sentiment, and trade tensions that keep volatility alive. Meanwhile, here at home, the narrative is equally layered. The Reserve Bank of India, or the RBI, just delivered a hawkish pause in the month of August. The growth continues to surprise on the upside and inflation remains benign. Yet the external shock of the US tariffs doubling to 50% has cast uncertainty over exports. Against this backdrop came the government's bold signal just yesterday night, the GST 2.0 reforms, a structural push that could unlock over 5 lakh crore of consumption, nearly 1.6% of GDP, right when India needs its domestic demand to stand tall. So, as yields rise and strategies shift, the big question for all of us today is how do we position fixed income portfolios, especially in an environment where global easing meets domestic reform? So, since the times are pretty interesting, so we thought, what better than today could be a day, to go ahead and have a webinar over here. So, today we have with us our CIO on the fixed income side, Mr. Mahindra Jaju, with us, and he'll be taking us through, the global part of the fixed income space, the domestic part of it, and then we'll be addressing the billion-dollar question that what should investors be looking at in the fixed income space at this point in time. So, a warm welcome to you, Jaju sir, and over to you. Right.
So, I think we are seeing a lot of volatility in the world right now, and that volatility is driven because of the geopolitical developments as well as developments on the financial markets. So, as a combination of the two, over the last couple of months, we have seen a lot of volatility. The Fed has been a little bit confusing in its guidance. So, in the last Jackson Hole meeting, Fed chairman indicated that there might be, situation which is now emerging where they could consider possible rate cuts, and at the same time, they have been talking about the rising inflation or the expected inflation spike because of the tariffs that have been raised in the US, and also the possible impact on the fiscal deficit because of the tax cuts that have been given. So it has been a sort of a confusing guidance and a bit of a muddled picture. But I think the economy has been slowing down in the US at a very significant pace. The You can see that the GDP graph is sliding down and the unemployment rate has been sort of picking up. As of now, the leading indicators are suggesting an impending slowdown and a possible spike in the unemployment rate, although the lagging indicators like the past quarters GDP number or the employment numbers released so far do not picture, such a grave situation. So overall, I think at this point one has to be a little bit circumspect about how the Fed is going to act. Fed itself is sounding very confused, but I personally feel that the conclusive, of the interpretation of the signals emanating from Fed should be that Fed would be on a course to cut rates at a very accelerated pace in the coming months. The inflation in the US is at around 3% right now. The Fed rate is at 4.5%. So we have a real rate of somewhere close to 1.5%. That is very high in a economy which is showing signs of a slowdown. And therefore I believe that Fed will be cutting rates in the next quarter, uh, maybe 50 to 100 basis points, and that's where uh, the market is preparing itself. So today there is more than 80% probability of a Fed rate cut in the September policy, and we'll see
Sure.
how it goes. Yeah.
Sure. So while you talked about the Feds, digging a bit deeper on the global side, that now we are also seeing that the US job market is slowing down, the consumer confidence is dipping over there. So how do you see US treasuries at this point in time, or in the near future, behaving in this sort of a backdrop? Also, specifically, if I ask you, on the 10-year yields, could those yields fall meaningfully? Or are the supply and the fiscal pressures keeping them on a floor?
So it has been a very interesting, time from the uh, long end perspective, because while the central banks across the globe have been cutting rates, we have seen that in most of the developed markets, the long term bond yields have been rising. Especially if you focus at US, you will see that the fiscal deficit in US has been higher than in a normal year. You can see from the blue lines that the US treasury supply has been increasing every year for the past few years, and at the same time you can see the percentage of the dollar as a reserve of different central banks, which is represented by the red dotted line, that has been falling over the past couple of years. So especially after the freezing of the Russian assets, after the breakout of the US, Ukraine, sorry, the Russian Ukraine war, there has been sort of a de-dollarization of the central bank reserves that has been happening, and because of that, we see the red line dropping. We have seen the gold prices at an all-time high as of yesterday. We have seen the silver prices at an all-time high as of yesterday. That is because of the replacement of the dollar assets by the precious metals like gold by most of the central banks. So it is very clear that the bond market is trying to reprice the term structure of the interest rates. As you can see that in most of the developed markets, while inflation is at or above the target set by the central banks, for example, in US, the inflation is at 3%, the Fed target is 2%, and the supply has been going up. So therefore, even though the central banks have been cutting rates in general in the US, because the Fed's last action was to cut rates, the ECB has been cutting rates. ECB has cut rates 8 times in a row. The UK central bank has been cutting rates, but the long-term rates have not come down that easily because of the expectation of the continued higher supply and because of the reducing demand. The one narrative which has been dominating the space in the fixed income world has been the challenges that the refinancing of the maturing debt will pose to the central banks and to the governments. So, for example, everyone talks about close to $8 trillion of US debt coming up for the refinance in the next 1 year, and then there's reducing demand from the other global investors because of the uh, you know the momentum of de-dollarization of the overseas investments. As of now, we have not seen an active sell-off in the US hills. However, there has been a lesser demand coming from the overseas investors. So I think that current ongoing trend or the trend is for the yield curves to steepen and steepen from the long side, which means even though the central banks are cutting rates, the long-term rates are going up. Now, there's one scenario in which this situation can change, and that is if the Fed were to start quantitative easing again. As of now, the Fed is on quantitative tightening. They are reducing their balance sheet size by uh, close to $20 billion every month. That was at 85, $90 billion per month before they slowed down the pace of quantitative tightening. So if they do feel the need for a quantitative easing, that will have a meaningful impact on the long-term rate. So therefore, I think today it's I think a little bit optimistic to expect any meaningful decline in the long-term rates in the global market. And I think to that extent, we need to also taper down our expectations at the long end of the Indian bond curve as well. But we'll talk about that a little later.
Sure. So to summarize that, in the current backdrop, especially for the developed markets, one can say that in the current situation, it looks like that their yields are going to be elevated so far. So then my next question is on those other central banks that you rightly talked about, like say the ECB, the European Central Bank, etc. So the Europe and the UK are still wrestling with sticky inflation, while Japan previously increased the interest rates and right now it's on a pause. So how do these divergent policies of different central banks around the globe they influence the capital flows and relative opportunities in emerging markets, especially on the debt side in India, if I have to ask you?
I think, Tanya, this is a very interesting question. And if somebody figures this out, then I think the entire riddle of what's happening in the global market and what to expect from the fixed income markets will address itself. So let's look at, for example, in three parts what's happening in the global markets. First, you look at US, where the growth is sticky, inflation is sticky, unemployment is sticky. Everyone is expecting the growth to slow down. Everyone is expecting the inflation to spike. Everyone is expecting the fiscal deficit to go up. As a result, while the central bank should be cutting rates, is not able to cut rates out of the expected reversal in the macro variables. The long-term rates are sticking higher. The curves are getting steeper. Then you look at countries like Europe and the surrounding areas. They have a problem with very poor growth, but they don't have the inflation problem. So we have seen that ECB has been able to cut rates 8 times in a row, right? And in spite of such an aggressive rate cut momentum, we have not seen any meaningful pickup in the yields, and now they are having to worry about the increased fiscal deficit or higher inflation because of the defense spending. I think you referred in your slide about the NATO related commitment, etc. So there is again a fear about the possible spike in the inflation and fiscal deficit. So in spite of again a very aggressive rate cut, we saw the French bond yields hit a 30-year high in the last week. We saw the UK bond yields hit a 30-year high. By and large, every country is seeing the highest bond yield since 1998 crisis in the Western markets, right? Then you look at country like India, or generally talk about emerging markets in general. So India is a good representation of the emerging world in general. So we have very strong forex reserve. We have a very strong GDP growth. I think the GDP growth at 7.8% for the previous quarter, I think surprised every skeptic, right? And then there were so many people who said, look, 7.8 is looking very high because of the low deflator, and therefore, the normalized growth should have been lower. And then we said, look, okay, what should have been the normalized growth? You take the deflator to be the CPI rather than the WPI. And even then the growth comes to somewhere close to 7%. So we have a growth momentum which is very strong. The growth momentum is driven largely by the domestic consumption and the domestic capex by the government, which has a very comfortable fiscal situation. We have the reverse problem compared to the developed world, where inflation is high, higher than the central bank target. For the first time in our history, the inflation is at 2%, which is half of
Right.
what central bank target is at 4%. Now we are aware that the inflation will rebound from here. It won't remain at 2%. And this year we have a God's blessing of excess monsoon. So right now most of the country is struggling with a little bit of flood, but by and large, the reservoir levels in our country right now is the highest in past 20 years. So we have a very strong economy, good reserves, low inflation. This is a mirror image of what's happening in the Western world. That allowed the Reserve Bank to front load all the rate cuts and inject excess liquidity through advance announcement of CR cuts. So I think if you look at where is the positive for the emerging markets, I think it's the assertiveness of being self-reliant and not dependent on the forex flows. We have seen sequential selling by the FPIs in the
Yeah, so you can continue.
So we have seen sequential selling by the foreign investors in the Indian equities market. We have seen some selling by the foreign investors in the Indian debt market, but still we have, very strong, what you say, the uh, bond market and the equity market. So I think emerging markets are emerging as the new source of strength in the global market. Is what I will say. That is where the opportunity is for everyone.
Sure. So, what contrast probably on the developed market side versus the emerging market side, especially in case of India, which could, add on to the incremental flows, is the strong sense of domestic driven economy that's there. So, on the last phase on the global part of it, so, with the Iran and Israel tensions and the NATO's renewed fiscal commitments, what are the risks that you see for the global bond markets? If I have to just ask on the global side, also, if the oil prices spike from here, or the fiscal deficit like we talked about on the US side, that also worsens. So what's your view sort of there to sort of conclude on the global side?
I think all of these are obviously going to be negative for the bond markets, right? So, all of these will mean higher fiscal deficit or higher inflation or higher, sort of geopolitical uncertainty. So, each of these factors by itself is negative for the bond markets. But I think there are two factors that we need to, account for. One is that market is already pricing in a negative scenario. So a lot of this negativity is already priced in. And therefore, to that extent, if those things do not happen, then I think the bond markets will be positively and pleasantly surprised. And to that extent, I think there is scope for the bond yields to remain stable. I personally think that the Iran-Israel tension or NATO's renewed fiscal commitment or the other geopolitical uncertainties in general over the past few years have failed to sort of affect the market sentiments very disruptively, because none of these events by themselves have been able to take the world by storm. We saw so many sanctions and all those things. So I think to some extent the markets are also aware that the world is able to deal with these issues without much of a disruption. So my sense is that we are looking at a scenario where the bond yields are already very high. So these factors on an incremental basis will not have a significant impact. Uh, Therefore, we can possibly feel a little more comfortable than we would usually be given these uncertainties.
Sure. So with this, viewers, we have concluded sort of on our global part. Now on to the next part, the India domestic part. what and how could be the effects of the global spillover beyond India, and at the same time the strength and resilience of the Indian economy. So on this part, my first question to you is that the RBI, or the Reserve Bank of India, delivered what many call a very hawkish pause in the last monetary policy. So do you think this stance will extend through the rest of financial year 26, or could we see, still another rate adjustment is if, inflation surprises either way? Now with GST 2.0 also coming, a question of inflation is also coming. So what's your sense like, on the RBI's call on the rate cut or rate pause side, from your side?
Sure. So I think the Reserve Bank's stance is already accommodative, right? They delivered a front-loaded 50 basis points rate cut. They delivered a CRR cut of 1%, which is under the implementation. And then they changed the stance to neutral. Now, from here on, I think the situation is to be analyzed in two parts. If you look at purely domestic factors, inflation at below 2%, uh, GST related expected moderation in inflation because we are expecting the prices of almost everything to come down, right? Then there is a, you know, uh, situation where the government is going to review the composition of the CPI, and there is feedback that most of the obsolete items will be excluded, and the CPI composition will become more contemporary, and that will have a sobering down impact on the inflation. So we have a low inflation, very strong growth last quarter, but a bit of a slowing momentum, good monsoon rains, and stable global markets in spite of all these uncertainties. So if you just consider the domestic factors, I think there is room for RBI to cut rates further. So possibly if you consider inflation coming back to 4% by April, uh, RBI still has room to cut rates by another 50 basis points to bring it down to 5%. But then the indication from the Reserve Bank is that they are not having any more space to cut rates. And why is that? Because the Reserve Bank is saying, look, this level of low inflation is not something which is natural to our growing economy, and therefore inflation is more likely to stabilize in the 4 to 4.5% band in the next 3 to 6 months time. And right now it is subdued because of the temporary factors like volatile food prices and base effect. The second is that globally there is a clear tendency for the bond yields to go up, and as I mentioned, that in France, in Japan, in US, everywhere the bond yields are, in UK bond yields are at 25-year high, 30-year high, and therefore the market is giving us a message that it is not happy with the high amount of the fiscal deficit. It's not happy with the high amount of the refinancing needs. It's not happy with the term structure, and therefore their market is demanding higher term premium from the bond issuers like the government, and therefore the long term rates are going to go up and likely to remain high. In that scenario, our bond yields are already at a very reasonable level given our historical trend. So, therefore, the difference between the global bond yields and our bond yields have narrowed to a very, very fine level, from where, if there is a disruption in the global market, that could cause a bit of a disruption in the capital flow situation. Our capital account balance has already been, very affected because of the lack of the FPI flows and also outflow on account of the FDI. So while we have sequential selling by the FPIs both in the debt and equity market over the last 1 year, our FDI balance has also been pretty much flattish. So as much as we are getting the overseas investors to invest in the Indian industries, there is an equal amount of outflow which is happening because of the remittances and return back of the past investments, and because of the Indian corporates investing in overseas companies. So therefore, we are at a very delicate level in terms of our capital account balance, and therefore, I think at this point RBI may want to wait and see how the global bond markets, behave, and then allow the long-term rates to come down. And therefore, I think the RBI's rate cut was very much a bullish rate cut. I would not say that it was a hawkish message that they wanted to give, but I think they also let the market know very well that look, at this point, we want to support the Indian economy by as much as we can, but then let the action remain concentrated at the short end of the yield curve, where the working capital finance is needed, where the home loan rates are set, where the car loan rates are set. Don't let's jump too early and too aggressively at the longer end of the curve, where the global flows can have the
Mhm.
potential adverse impact on our currency, etc. So I think that's a very well balanced message. Given that, I will say that to conclude, I think it has been a long answer that purely from a domestic factor, there is a easy space for uh, you know at least a 50 basis points rate cut. That will get triggered only if the global situation improves further, which allows the RBI the courage to, or the encouragement rather, to go for that. So we have to now watch the global space, whether it
Mhm.
allows the central bank to deliver those rate cuts which very much are possible given the domestic factors.
Right. So a global, what the backdrop in the global environment is versus how, the whole GST 2.0 reforms play out versus how the growth plays out and inflation plays out would be a determining factor for RBI rate cuts. Very rightly said. So the next question is that, the GDP growth, like you also mentioned, came in much stronger than expected at 7.8%, while the inflation also, had cooled sharply in the month of July as well. So how sustainable is my question is then, is this Goldilocks sort of a mix for India wherein the growth is very strong, the inflation is like you only mentioned, for the first time within the band levels of the RBI. So especially with the global tariffs play in the backdrop, how sustainable is this Goldilocks mix sort of for India?
So honestly speaking, I mean, my guess is as good as yours or anyone's, because today we are facing so many uncertain factors, and it's very unpredictable. As of today, you may believe that we have a 50% tariff, and tomorrow it can change to 0 or 25. And so if you look at the domestic factors again, you can look at the slide on the screen and say that look, inflation has not behaved better than this, any time that I have memory. The growth is very very strong against anyone's expectation, driven by the domestic consumption, government spending, construction. The government spending is in right direction, and these are all historical data. But as we speak today, as you rightly mentioned, we are on a historical day where we are right now experiencing one of the most aggressive reform ever. This is the most aggressive cut in indirect taxes ever by the government in our country. So that is going to have a strong spillover impact on consumption, on growth, on inflation, and everything in the positive direction in this scenario. So then the only remaining concern is whether the fiscal deficit will get affected because of these concessions and etc. But then the estimates given by the government is of just about 50,000 crores for the current year, which is very small amount compared to the overall size of the balance sheet of the government. And then there are so many alternate sources from where this extra money can come. For example, our PSU sector is doing very well, so there can be extra dividend from that side. There are a couple of investment possibilities from the private sector to the government. For example, sale of IDBI, for example, that can happen. So I think today we are in a very positive scenario. As far as the global environment is concerned, a lot of analysts have said that 2% of the exports, I mean 2% of GDP is just the export to US, and that can be replaced by other countries. I personally feel that to have an antagonistic situation vis-a-vis US is in some way going to be detrimental to our overall positioning. But at the same time, right now we are in a very strong environment, so we can absorb that for the first 6 months. So as long as you believe that in the next 6 months we find a constructive and positive solution to the whole tariff situation, then we are looking good. And which I think is my belief that we will arrive at a very constructive solution, because no country in the world today can you know behave to the exclusion of the concerns of the other countries. And we have some real challenges in terms of some of the tricky issues like dairy farms or agriculture, but I think the solution will come. So uh, I think over a period of time, I feel that what we call the Goldilocks scenario today should become the new normal for India. That is my belief. So
Okay.
it would also suggest that I expect our country to go from strength to strength in the coming years and centuries.
Sure. So, moving on, on this, I'll be asking you on the US tariff a little more. That, now that the reforms are there, like you like rightly mentioned, the domestic consumption boost or trigger is being tried by the government of India as well. But is there a probability that, that US tariff could damage the Indian economy? If yes, then how damaging could that probability be to the India's growth story? And the follow-up question to that would be that, do you see the consumption, domestic consumption, and the GST2 reforms offsetting that export drag? I know you partially answered that in your previous one, but in case you want to, throw up any more facts further on this question.
Sure. Then, as you rightly said, that we have covered this in parts in the earlier questions, but this is a very, I think, well articulated question, and therefore it certainly can be answered in with more detail. So, I think your question is in two part: how the U.S. tariffs affect the Indian position. The other is, can the domestic consumption and further boosted by the GST reforms can handle that? I think these are, as you rightly said, two exclusive domains. So I don't think that the domestic consumption can compensate for the US tariffs, because US tariffs are going to hit us at our most vulnerable spot, which is the external sector, right? So we have, say, for example, a current account deficit of the order of 250 to $300 billion, right? uh, Sorry, the trade deficit of
Right.
order of 250 to $300 billion. Now, if your trade is disrupted, you still need to import what you import, and if you are not able to export, then obviously it is going to affect your reserves. $700 billion reserves at 12 months of worth of import. If your imports increase, export decrease, and that consumes some of the reserves, and reserve falls to $500 billion, it can suddenly become 4 months worth of import cover, right? So things can change very fast. And therefore, to that extent, I think we should not underestimate the adverse impact of the tariffs that can happen. So I am fully cognizant of that. As you can see that the exports are, largely from the gems and jewelry and, those sectors. So those are the sectors where there is a high degree of employment because they employ thousands of people. And textiles, for example, there are very serious competitors uh, in the other Asian regions like Bangladesh or Vietnam, who are just waiting to grab our markets here. So uh, if that happens, and if that leads to a currency crisis, or if that leads to a rundown on our forex reserves, that's not going to be helped by the fact that we have higher consumption. Our higher consumption may actually act as a negative factor for that, right? So I think it is important that we resolve these tariff issues at the earliest possible. Now, it's not something that we can do entirely on our own, because we can't clap with one hand. So we also need the same supporting sentiment from the other country, which is US. And I think the government is working on bringing up that environment where that talk is again possible. And we have heard couple of reconciliatory noises from both sides in the last couple of days. So I would say that the if the trade issues are resolved, then the GST and other reforms, consumption-led economy will act as that catalyst which will catapult India into that 8% growth trajectory. If the tariff issues are not resolved, then it will not be as if everything is lost. We will still grow at 6.5%. I think for now, India has enough reserves and fuel to sustain that, especially if the SCO kind of a format picks up, if the RIC format picks up, then we are in a healthy situation, but not the ideal situation. So let me just rephrase and close this issue by saying that it is best if there is a good resolution to the tariff issue. If it is not, it will affect us at the margin. So our growth will drop from 8 to 6, but 6 will still be there.
Right. Sure. So, with this, you gave us a clear picture that, while the US export part is also an important part of, the Indian economy, but at the same time, the domestic consumption cannot fully fulfill it, but it could sort of, till the time the negotiations are on or we don't reach a conclusion there, that could sustain us. So, right. So now coming on to the more core of the Indian economy, the high frequency indicators or the macroeconomic indicators as widely known in it a particular segment, that is the rural versus the urban segment sort of a thing. Over there it shows that the rural demand has been the cornerstone of growth for the last 6 months. However, there are now signs of slowdown in the last 6 months. I would also like to highlight that the urban consumption was not picking up, it was lagged a little bit. And now on a cumulative basis, while rural demand looks very bright, but on a month on month basis it has started diminishing a little bit. So how do you see this rural and urban divergence shaping the credit growth and also the bond yields in the Indian market? So yeah.
So I think after the today's GST reforms, no one should have doubt about the revival in the urban demand, right? So that is, I think, given now that the urban demand will pick up. We are seeing, for example, drop in the domestic air passenger traffic, for example, as you said, or retail passenger vehicle sales. Now, if the vehicle sales prices are going to drop by 10%, then I think there will be a huge boost to the demand. And we had the chairman of the Maruti, Mr. R.C. Bhargava on CNBC today. I was watching him earlier, and he said that look, price drop should be somewhere close to 8.5 to 9%. So that's a quite significant drop in the economy segment of the passenger vehicle. So I think that demand is going to be revived. As far as the rural economy is concerned, I think we are seeing a bit of slowdown because there has been a sort of an excessive rainfall situation. Especially the northern part of the country has been badly affected because of the landslides and floods. Those situations will get over in the next 15 days because we are now just about at the end of the monsoon season for the current year, and then the festival season will start. The government is also going to then start distributing the money under different schemes. So therefore, I think at this point I'm very very positive on the demand pickup, and that is obviously going to be positive for the bond yields because uh, a good demand pickup will mean good growth. Good growth will mean good revenue collections, and that should be a happy situation for everyone. Now, what happens in that scenario is that we do not expect RBI to be in a hurry to cut rates, which means your bond yields are not coming down in a hurry, but they don't go up. So you are looking at a sort of a bond yield environment where the bond yields are stuck in a narrow range in this environment.
Okay, sure. So, in the middle of August, there was, this huge news that S&P has upgraded the Indian economy's, India's rating as it is called. And, so I would like to know that how significant is this S&P's upgrade is for the Indian debt space. And, over the past years, we have also seen the 10-year GSEC inclusion into various international bond indices in that sort of a backdrop. And beyond the optics, will it meaningfully lower the borrowing costs or attract new categories of investors for Indian position India in towards the leading EMs in the whole set of emerging market space?
So I think earlier in this webinar, we were discussing whether or not this Goldilocks scenario for India can continue,
Right.
for a long period. So whatever I and you believe, I think S&P definitely believes that, because their announcement of a rating upgrade came after the US tariff, complications were known. So I think
Correct.
they definitely, it's a very strong vote about the core, strength of the Indian economy, and of the strong fundamentals of the Indian economy. Therefore, I think the confidence shown by the global rating agencies at this point in time is very meaningful, and it is obviously going to open the floodgates for the Indian corporates to borrow from abroad. And if you track the data, I think suddenly the Indian corporate borrowing from the ECB market has gone up significantly. There are a lot of NBFCs also which are now again beginning to talk about tapping the global bond market. So there was a time, till 3 months back, when the global rates were higher than the domestic rate and the arbitrage was not working. But now with rupee at 88 or a lifetime low, with the forward premiums crashing, with the global bond yields stabilizing, I think the funding source for the Indian corporates from overseas markets will definitely open up, and triple B rating will also allow a lot more investors to invest in the Indian debt. So that's a very positive. At this point, again, we don't see any meaningful impact on the domestic bond yields because of this. We are looking more at a substitution of the funding source rather than change meaningfully in the cost of funding, because we are at the you know uh, pause phase of a very strong rate cut action by the central bank. So in the next phase, it will be beneficial for the Indian corporates.
Sure. So, with that, coming towards the more on-ground situations that are, upcoming in the Indian diaspora, that, with the festive season and the Bihar elections ahead, how should we expect that, RBI could manage the liquidity, and what implications does this sort of could have on the, short end versus the long end side of the bonds?
So I think from the chart, you can see that RBI has been progressively tweaking its stance on how it is managing liquidity. So RBI is like the marathon runner who has done the long, end of the run. Now they are approaching the end. So they have, in the months of January to March, maybe till about May, injected liquidity at a very, very accelerated speed. They cut rates at a very fast pace, 100 basis points of total, out of which 50 happened in June itself. And then once they exhausted all the possibilities that existed in their control, they started to stabilize the market. And now I think their effort is to remove the excesses from the market, try and align the money market rates to their current repo rate. In that process, they are doing daily variable rate repos and reverse repos. So I think right now RBI is in a mode where they are wanting their actions so far to be transmitted to the broader market. So their focus is on transmission of the measures that they have taken already to the broader economy, and not allowing any excess froth to build up in the system. And therefore, I think we are looking at a range-bound, stable market. As I already mentioned multiple times, I expect the bond yields to be range-bound. I expect most action to happen at the short end of the curve.
Sure. So now, building up on this, and I can see on the viewers side a lot of questions coming up in the Q&A box. So we are just about to conclude on, our take with the Jadu sir, and we'll be opening Q&A session up post that, just another 5-10 minutes, viewers. So, sir, now that we have approached the conclusion of the whole webinar, at the end of the day, what's the call to action? That is what a lot of investors want to understand, that, okay, so and so is happening on the global part, so and so is happening on the domestic part, but as an investor, what should my highlights be? So on that, I would like to ask you that, given this macro sort of a setup, what all you said, what all is probable to happen, say in the next 6 months, 12 months down the line, where do you see the best opportunities? Short end, mid, or long end of the curve?
So let me summarize my current assessment by recapping what we have discussed so far. Okay. What we have discussed so far is that globally, every central bank has by and large cut rates in the last 6 months. The US central bank has cut rates at a slower pace than the European Central Bank, and Indian Central Bank has been the most aggressive of all the global central banks in front loading all the possible ammunition at their exposure. Then the second thing that we discussed is that there is an unmistakable trend of the long-term bond yields going up across the world because everyone is now worried about huge supplies, large fiscal deficit, and the need to refinance large amount of debt at a time when the demand is slowing down. So, and that is a situation where the geopolitical uncertainties are having a huge role to play. There are multiple geopolitical hotspots in the world right now, from Gulf to the Asia. And if you go beyond India, maybe one hotspot which has been out of a headline for some time is the China Taiwan one, right? So in this situation, I think the long term bond yields have already corrected, and there is, in my view, time to focus on accrual products. The short term rates have come down. The liquidity is high in the system. The CRR cut is still to be implemented fully. So the money market curve is very steep. So in my view, without spending too much further time, the money market fund, the low duration funds are the two funds in the debt mutual fund space for the conventional investor, which prefers low to moderate risk, the appropriate funds at this point in time. Then, you know, there is one major advantage which is coming back to the debt fund investors, which is the long term capital gain eligibility that is available in the entire debt space right now in only one category, that is income plus arbitrage FOF category. So that category, for people who have the investment horizon of 2 years plus with a moderate risk appetite, is something that is just not to be ignored, because even if you make a little less or more return with a long term capital gain tax treatment at 12.5%, your net effective retained earnings or returns are going to be far superior. Then there is another very significant situation here. We talked about uncertainty, uncertainty, and uncertainty at a time when central banks are either in the process of cutting rates or are expected to cut rates further. Therefore, there is a possibility that market may overcome the concern of supply and again latch on to the long-term bond yields. The one category which can give you the tax advantage without losing that opportunity is the income plus arbitrage category, because it's a category where we can, as fund managers, make dynamic allocation. So tomorrow, if the outlook changes, we can switch from money market funds to the bond funds. You can't do that in money market fund to do bond fund at that point, because you may do that, but you will first of all need to understand the complication of the market and also be prepared to forgo the long-term capital gain tax benefit. So this is one category which I put a lot of value for now. So in my view, between the two categories, a well spread investment depending on the investment horizon and risk appetite would do well given the current situation.
Right. So the call to action would be money market and due duration funds on one end for investors who are conventional, who have low to moderate risk appetite, and on the other hand, it would be income plus arbitrage fund of fund category, which underlying has a lot of other debt funds as per the current market, which is decided by the fund manager and is suitable for investors who have moderate risk appetite and investment horizon of 2+ years. Sure. So, sir, before I take questions of our viewers, just one last thing from my side, that if you have to, in a couple of lines, had to flag one risk and one advantage of the India's fixed income space over the next 6 months, what it would be?
I think the risk is clearly on the supply side because you know we have the estimate about the extra fiscal space that needs to be created because of the GST rate rationalization. God, right now everyone is talking of 50,000 crores, but then it could be more. So that is one, because again a lot of people were expecting the rate GST reforms to come in a little later, but it has come at least 1 month advance of Diwali. So I think people will use it, for example, in consumer durable space, hopefully. So that I think could be fiscal constraint. And then so far, while the fiscal balance sheet looks all right, the tax collection efficiency ratio is not as much as is the projection in the budget. So there could be one situation where there is more than expected supply in the bond market. That could be one risk to the long term rates. Advantage obviously is that if the Fed also starts cutting rates aggressively, and especially if the Fed uh, starts quantitative easing, then I think the whole outlook will change. And then suddenly people will be very happy if they have allocated to the income plus arbitrage fund, because there will be able to switch to the long duration fund. So I think that opportunity is, and it relates to where we started. We said, look, Indian environment calls for more rate cuts, but the global environment is holding it back. So if the global environment improves, massive opportunity for fixed income. If the fiscal deficit is higher than what we're expecting now, that could be a risk factor for the bond market.
Sure. So with this, sir, while we are concluding, our part of the webinar, let's now move on towards, the viewers part of the webinar and addressing their questions. So yeah, so the first question is by Mr. Sekar Sangitham. Considering another rate cut of 25 basis points in India in the next 3 or so months, what would be the debt fund to invest in?
Well, we have already mentioned that in our view right now, the two categories that one can look at is the money market and low duration on one side, and the income plus arbitrage on the other side. Let me just spend 1 minute on this. The market reacted so negatively to the 50 basis points rate cut by the Reserve Bank because they thought it is the last rate cut, and therefore they can then price the 10-year as anchoring the policy rate at 5.5%. Even if the Reserve Bank cuts rate one more time, that will definitely be the last rate cut in the cycle. So market reaction won't be materially different. So I think at this point, the action at the long end is not a function of whether the RBI cuts rates further or not, but whether the global environment improves for the long term rates. That looks a little bit challenging. So I would say that at this point, the allocation to debt funds should not be based on whether or not the Reserve Bank will cut rates further, but whether our global environment will improve materially from here. And considering that, I would still say money market fund, low duration fund, basically, to put it in other way, not very aggressive on duration strategies right now.
Sure. So another question is on the state development loans, that how do you see the HTL in at the current juncture, especially the longer tenure HTL, which are, in the 7.5% zone. Could one add these to the portfolio right now?
So if one is looking from a purely accrual perspective, from a buy and hold to maturity perspective, and if he's happy with 7.5% accrual, yes. But if one is looking at a dynamic portfolio where people want to maximize return and minimize risk, then I think there is no need to rely on that, because uh, just think of this, that with the GST rationalization, the people who will be most affected will be the state governments, because a substantial part of the relief that has been given would have otherwise gone to the state government. So I
Right.
think state government sector is not something which is looking very exciting right now, unless Reserve Bank takes some actions like reducing the supply in that segment, which the banks have been making and which you would have read in the newspaper. I think that is looking like a little bit of an avoidable spot in the fixed income space right now. But as I said, if somebody is looking to hold till maturity, then at 7.5 they look good.
Sure. So there are a couple of questions on the long duration fund. So I'll club them for you. And the question reads like that, what's the view on long duration funds, especially, if there are two scenarios that people have asked. In case there's a US hike of rate cuts in between of a deteriorating balance sheet, and, in case the Fed, goes with the status quo, or, has a pause, or goes through a rate cut cycle. So what would be your view in these scenarios be on the long duration fund?
So my view on the long duration fund is very, very clear that if someone has a long term investment horizon, so if anyone has a say 2 year to 3 years of investment horizon, long duration is an excellent opportunity today, because the underlying fundamental thought process is this: as long as you remain invested through one complete interest rate cycle, you will make double digit return plus in long duration fund, is my experience and my thought process. But if you are looking at the investment for next 3 to 6 months, I think long duration is something which is not in our suggested list. So obviously we are not very positive on that segment for a short term exposure.
Sure. So Mr. Abhijit Agashe has a question that can you throw some light on the FPI flows in the Indian debt market?
So FPF flows in the FPI, you mean? So foreign investors have been shunning the Indian markets on the debt side for some time now, obviously because of the different complications. Last year we got huge flows because of the inclusion of the Indian bonds in the index, and that was one-time exercise because the underlying AUM of the index itself hasn't grown that much. So this year the incremental flows are very, very minuscule. And then in the first quarter of the year, RBI was doing very aggressive open market operations. So we did not feel the slowing down of the FPI flows. After the correction in July, there is a little bit of trickle which has again started in the foreign investors segment for the debt market. But I think by and large, the uh, foreign investors have too many things to look at in the global space. So we are not very constructive in that segment. We think that API flows will be not large enough to excite anyone. They will not be large enough outflows to bother anyone. They are going to be very marginal player in the debt market for now.
Sure. So another question, and probably the last one, is by Mr. Vrindaman Khandelwal, that do you feel any risk in the STL repayment of maturity or interest? As you know, like you rightly mentioned on the GST 2.0 part, the state coffer could see a reduction. So what's your take over, the payments by the STL on the side of interest rate, or, on the repayment?
So as of today, if it is an SDL, which is state development loan, I don't see any possibility of any default or any such thing. That I think is becoming too negative. Because the SDLs are serviced by the Reserve Bank, they are allocated by the uh, you know central government. So the states can borrow under SDL only under the approval from the central government. So therefore, I don't see any challenge in terms of the servicing of the SDLs. Other than SDL, whatever is the state government borrowing, that I think is a different issue. And you can easily see that why I'm saying that, because every SDL is rated as sovereign, whereas every state has a different rating. So as long as you are talking of only SDL, no risk in my view of repayment at this point.
Sure. So, sir, with this, any concluding remarks that you have for our investors?
I always feel that the debt mutual funds are the best option available for a debt investor. So people have different choices. People can do bank fixed deposits, people can do direct bonds, and people can go for high yield. Our experience is that the debt funds have been the best option. They provide immediate liquidity, they provide a good portfolio. However, the debt mutual funds are a market related instrument, so there is a bit of an excess volatility at times in those funds, but there is no free lunch anywhere in the world. So the cost of better returns and higher protection in the debt mutual funds is to accept a bit of volatility. People have started earning good returns in equity because they have embraced volatility. People will earn good returns in debt if they embrace volatility in debt. The most erroneous argument I ever hear from people is that why should I invest for 50 basis points or 100 basis points extra in the debt mutual funds where there is volatility and not in the bank fixed deposit. People don't understand that if you're earning 5% in bank and if you're earning 6% in debt mutual fund, you are earning 20% more, right?
Correct.
If you earn 1% more over next 25 years, your wealth will be higher by 30%, right? So compounding impact of that. So that, mental calculation that 1% is not worth all the trouble, I would say that is worth all the trouble. Not so much the trouble, but just the volatility. And the last thing I want to say is that again, people say that whenever we invested in debt mutual fund, we did not have a good experience or we had very bad experience in certain cases. I think that would be always the case if you don't do a good due diligence, because there are debt funds which did very well even at the worst of the or the peak of the crisis. So you can get duped or you can make a wrong choice anywhere, anytime. You can do all your research and still end up at a restaurant which serves you very bad food or very good bad service. So the problem is not with the debt mutual funds. Problem maybe with the way we do due diligence, etc. So please consider that. I think that this is one of the best platform to park your fixed income allocations.
Sure. So as the saying goes, certainty, uncertainty or volatility is the only certainty in life. So right, sir, thank you so much for, sharing your insightful thoughts on both the global markets and Indian space, and of course, actionables for investors with us. And for investors, this is a moment to stay selective, stay agile, and look beyond the uncertainty, like Mr. Jadu rightly said. So thank you all for joining us, and I look forward to connecting with all of you again as the conversation unfolds. Thank you, sir. With this, we would like to end the session. Thank you, viewers. Thank you, sir.